Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the Econ Show, we were gone last week, or I was gone last week. I was down in Tennessee, and then I'll be gone next week in Calgary. So bouncing around, but a lot of things to catch up on. So the first part we want to look at is world activity. It's staying in contraction. We had a little bit of a bounce, but we want to look at what is happening on a geopolitical front, what's happening on an activity front, looking at services, manufacturing, and then more importantly, going into trade and how trade issues remain, and then at the same time, how that's promoting more inflation. Then we're going to turn to the U.S., look at how inflation is accelerated, why we think it's going to continue to remain elevated through September. And based on what's happening right now, it's unlikely we're going to see a shift as we go into October and potentially November. So we want to go through some of those key pieces. Then we're going to look at wages. Wages have started to roll over, but that's a problem when wages are rolling over as prices kind of pivot back up. And again, that just makes real wages that moving it further negative and impacting the consumer, to another level. Then in Europe, we're going to talk about growth expectations, which have officially been reduced. I know, finally, in terms of where we are, and we're going to go through some of those updates. And then we want to look at China. They've rolled out some additional stimulus, but we still don't see it delivering growth. But at the same time, the stimulus that's been rolled out, it's not meant to. It's more meant to kind of stabilize where they are and let the market kind of work through some of the underlying issues. So pivoting right into segment one, we want to look at some of the stress points that we've been seeing and hearing and talking about. So when you look at naval movements, so China is doing some war games, live fire in the Taiwan area. There were reports of a potential nuclear powered sub having an issue in the Taiwanese Strait. Then there were some crossovers of the demarcation line. So a lot of noise, we don't see, so far a lot of things haven't happened. The Taiwanese Navy has been tracking some of these areas. Chinese warships and aircraft carriers gather east of Taiwan for the major naval exercise, 20 ships deployed nearby. A new daily record, 2 times the surface action groups likely to link up. Massing forces at coastal military bases, never before seen flight paths. Again, so all of these things are meant for a live fire updates. China launched a large-scale military exercise in East China Sea, the 6th to the 10th. The aircraft carrier battle group sailed by southern Taiwan. 2 surface action groups, including 8 warships, transited the Philippine Sea. Taiwan tracked 48 PLA aircraft around the island with new and unusual flight paths. 24 crossed into the ADIZ zone over the 2-day, which is just that demarcation line of where does Taiwan airspace, where are you allowed to launch a military inner escort, if you will, or, because it means that they're coming too close. Taiwan detected 20 PLAN warships operating nearby, the highest total ever recorded in a single day. So there's a lot of movement and again, a lot of saber rattling. I don't know if people have seen, but there's going to be a pivot in the way the U.S. is spending some of our let's call it military dollars or soft military dollars. So we are sending more to Taiwan. I think in this current 2024 budget, it's set up for about $320 million to go to Taiwan. We have sent additional capacity to Ukraine. And I think it's important because we had these conversations when I was at a wedding up in Rhode Island. So when the U.S. military or when the news gives a monetary value of what is going over to Ukraine, it's the value of what's going. There is some cash. I'm not saying that there isn't, but it's a lot of it is equipment. It's equipment that is maybe older. It's not going to be used, and it's reserves that can be sent over. So when you think about what has been done within, let's call it by investing 3% of our military budget into Ukrainian efforts, we've enabled them or given them the capacity to cause some significant damage to the Russian military, from the military side, from the mechanical side. I mean, for a country that doesn't have a navy, they've taken out and have damaged significant naval assets. And again, we've just given money and support. So I think you have to put into context what we've achieved without putting U.S. lives at risk, and instead using equipment that was maybe ancillary. It could have very well never have been used, within 20 years may have been destroyed. So I think it's important to put into context, where we sit on a geopolitical front. There's multiple issues that are currently happening. We talked in our last econ show, the back and forth between China and India. So again, there's a lot of things to watch as their economy is struggling. Apparently, Xi had a meeting with some of the party elders, and they are not quite thrilled with what has happened, which isn't surprising. But we want to go through that in more detail as we go through segment 5. So now, when you kind of put that geopolitical backdrop, because the reason why we talk about that at the beginning is because it's going to be a pervasive thing throughout. When you look at trade, when you look at capital flow, when you look at goods flow, when you look at some of these, and then when we get to food, because there's a lot of pieces that come into that when we're looking at the geopolitical strife, especially in that Eastern Europe and Asian region. So global liquidity is down $1 trillion over the last 10 weeks since the high in 2022. $4.2 trillion in global liquidity has dried up, and we're back down to pre-pandemic levels. But that we are now back down to, when you look at that pandemic side, you kind of get an idea of, how far we still remain from that piece. And this is what we've been talking about for a significant period. After printing and handing out almost $4 trillion in stimulus while lowering rates to 0% overnight, you still have a significant amount of liquidity sitting out there. So, when you look at it in general, we saw 11 trillion get added from 2020 to the peak at 2022. We've talked about why they should have stopped much sooner, but you've only taken 4.2 out. But then from that 08 into that 19 level, the 20 level, we added almost $12 trillion. Like, that is a significant amount to come into the market. And so when you look at where we are, everyone's like, oh, look at that. It's going to be a huge panic. It's like, but look at what was added into the market. This is why when you look at the inflation side and the amount of liquidity that was added from 08 to 2020, and then just the massive surge that went through, there was a huge issue, and there's no such thing as free money. And that's why when you look at the liquidity crisis, there's still pockets of liquidity out there that have to be absorbed, which is why we still don't see any of these changing patterns. And that's when it's important to look at what is happening in Japan. So the Japanese 10-year bond yield is at the highest it's been at in almost, I think it's over a decade now. It might even be at 20 years. And for those that remember, they've been saying that 1% is the ceiling, but they would start to get more active as it crossed and breached into this region. So you can see here in that 50%, that 0.5%, you can see where they held the floor. And then they yielded. They couldn't maintain it. And the problem is, this is where we see a huge problem when in regards to underlying bonds, the developed bond market. We believe that it's going to occur, or at least a bigger credit crisis is going to start in Japan. They're going to get rid of the ceiling, raise rates. You're going to see a big spike in yield. You're going to see the yen, at least start to reverse in terms of some of the strength, because it keeps pushing higher. And that 150 level, again, that what was once resistance becomes support, and that's something where they're going to try to, I think, bring down, strengthen the yen and allow some of this to rally up. But it's interesting when you look at the IMF, and this only goes to 2022, and I can assure you it hasn't improved in 23, the number of trade restrictions imposed annually. And one of the components that we talked about was the Rose Garden lie, which happened in 2015 between Obama and Xi. And that was when we had said the precedent has now been set. That was something where Obama outright asked Xi what was happening with the Spratly Islands. He said it was purely research. And then within 3 months, you had the delivery of radar, advanced radar, surface-to-surface missiles, surface-to-air missiles. So you had the armament of these 9-dash lines. And that was when, in our view, in my view, and something that I had laid out, I think, very clearly, was that we were going into a bigger conflict. And the conflict wasn't going to be hot, it was going to be cold, and it was going to be trade related. And that was where I think, in our opinion, that it really began. And that is I think, not a surprise to see it getting ratcheted up each way. And even as we have, quote unquote, officially or unofficially taken away the trade war with China, many of those restrictions are still in place. And it's not something that we see improving, and that's going to be a bigger problem because these issues increase inflation. They provide price inelasticity, which creates more problems in general. So the quietest trade war in history, total trade restrictions worldwide are about to cross 3,000. This is nearly up 300% since 2019 and rising quickly. Trade relations and energy resources are being weaponized. As a result, supply side inflation has been very high. Fighting inflation in this environment is obviously extremely difficult, making the Fed's job all that much harder. But realistically, it's not just what's happening with China. It's also what's happening with Russia, Ukraine, what's happening with OPEC. And these are components that are going to continue to be some of these overhangs. August global manufacturing PMI was up 0.6 to 48.2, yet it still remains obviously below 50 in that contraction. And that was what we were saying with world manufacturing. We were going to kind of flatline and bounce from here. World manufacturing surveys activity versus price components. So price components are coming closer and moving, and what we believe is already in expansion. So now we've gone from contraction on price pressures to expansion, and that is again that pickup in inflation, which we see accelerating and going to be a much bigger issue in general when you look at some of the rising prices and what that's going to do on the underlying consumer. PMI activities components rose by 0.2 to 47.7, which is driven by emerging markets. Asia being the one which, excluding China, remains the region with the highest PMI activity and by a wide margin. And that's that emerging market piece of when do we see that further slippage? But that's where most of the world's manufacturing still resides. So you're still going to see a certain amount of activity. It's until we get a much bigger slowdown in some of the developed world, it's going to be difficult to see that bigger hit there. But when you look at world activity, output, and new orders, we're still projecting contraction. And that is going to weigh on the emerging markets, which have already started to take down some of their support, some of their ways to kind of mitigate against inflation, and that just based on cost, which is why we see some of the additional slowdowns. When you break it down by country, 30% of countries stayed in expansion, of which 9% are slowing down and 18% are accelerating. India and Indonesia have the highest, which, again, is just a matter of that shift. 39% are recovering, 30% are deteriorating. And again, you kind of get an idea how we're settling for the most part on that deteriorating side. You have some recovery, but again, it's just bouncing back and forth. And the Eurozone being here, when you look at the new data, you can see the Eurozone has now fallen down into a deteriorating, France, Netherlands as well. So again, you're going to see some of that slowdown continue, and that'll weigh on some of those emerging markets and underlying trade. World price pressures and inflation, as we've been saying, the world headline inflation rate has seen that little bit of a bounce, stabilizing in that 4.4%. When you look at world price pressures 6-month leading, it's come closer to, but has bounced, and closer to that expansion. We do believe you will bounce into expansion, which is going to push things a bit higher, because this is looking at August. And as we talked about, we saw the end of July leading into a big August push, and we see another big September push, which is going to keep this elevated. Developed markets inflation rate and price pressures, continues to move higher. Global inflation components show that short-term pressures have rebounded from the 7-year low and remain, but are continuing to move back above that average. Now, when we start looking at some of those pressure points, so consumer food prices have stabilized, but then when you look at some of the corn yields and other key yields, the U.S., as we were talking about since 16, was really that last year we had that high level. Now we've seen that pretty kind of, let's call it a stable level here. And that's going to become a much bigger issue, where when you look at Brazil has seen some sizable increases on the corn front. But again, when you look at total market share and just the availability out there, even as Brazil has gone up, well, the U.S. has come down. And again, this is moving away from the impact of the farmer and just looking at the impact on a global level. We have not seen any meaningful addition to help close the gap from the slowdowns that we've seen in terms of available food that really started to accelerate in 2020. And this, again, just looking at corn yields, as we talked about, 2016 was kind of that last high point. And we've really just gone sideways from here. We haven't had a meaningful increase or bumper crop, due to usage of soil, the overusage of different fertilizers, and then as we carry that forward with just the weather patterns that have shifted and causing a lot of issues in terms of growing seasons. Now, China's exports, they've asked people to curb some of their fertilizer exports. When you look at it in general, top importers of urea from China. When you look at India's at 226,000 tons, others at 600,000 tons. So China's asked some fertilizer producers to suspend urea exports after domestic prices jumped, a move that's likely to restrict supplies and boost costs for farmers in some key areas, and especially in China. And if you think about China, who's already put gates up and has banned non-basmati rice exports, they've put gates up and 40% increase on export taxes on basmati rice. You get an idea of how this becomes a much bigger issue. Then when we look at the share of global mineral deposits in terms of cobalt, you get an idea of kind of where the pivots are, where the focus is. Here you can see then the Democratic in Congo is where all of that cobalt resides. Copper is obviously heavy to Chile. Lithium is heavy to Argentina. Nickel is fairly balanced between Australia, Indonesia. But then you look at the share of global oil and gas production. When you get some of these pivots, it's a matter of balancing. And that's where, if you look at where the minerals are for EV batteries, you look at where the resources are for hydrocarbons. If you balance the two of them, you don't give any one of them again, the biggest amount of strength. And especially when you look at global mineral deposits, China controls a lot of that. Even if they don't control the mine or are invested in the mine, they control the processing, they control the assembly. And then when you look at the share of oil and gas, obviously Russia has a higher component. So again, you don't want to help Russia. You don't want to rely too much on China. So it's, again, that balancing act between all of these different entities. Now, when you look at copper, there's obviously those bigger issues when you look at refined copper consumption and copper ore production. Copper ore production continues to fall, but we are getting scrap and secondary copper production coming up, and that has helped close the gap between that copper ore production and where that refined level is. And as long as we can maintain secondary copper production, we'll be able to close some of that gap. But then you come down to quality. What is can this be used? Does it need fresh copper ore? And again, these are going to be some key components to watch as we get restrictions on new capacity, new mines, and that will restrict some of these new developments, which is going to be important to watch. And again, this is also inflationary. You know, when you look at some of the raw materials, and that's why we do see that stagflation, because you are seeing some of that mismatch. So if we do get a hiccup in scrap, that's going to create a fairly sizable gap, which again is going to push up prices. Even as demand falls, or demand doesn't really rise, production and supply becomes a bigger issue, which is where we get that stagflationary fear.